Warren Edward Buffett, arguably the best investor the world has ever seen. His investment philosophy and techniques has grown his personal wealth to over $100 billion. Since taking over a struggling textile company called Berkshire Hathaway back in 1965, Buffett has had his eye on individual stocks, trying to beat the market to help benefit the shareholders of his company. He has done this very successfully with his average rate of return coming in at a staggering 20%, beating out the S&P 500's 10%. What is interesting about Warren and his techniques is that he doesn't actually recommend the everyday person to invest like him. He believes most people should passively invest into a market tracking index fund. So today, I want to dive into Warren Buffett's reasoning of why passive investing is the best form of investing for many of you inspiring investors out there. But firstly, I know what many of you must be thinking. What is an index fund? Isn't investing risky? And when do I become rich? Well, what if I told you that if you save $200 per month at an 8% average return over a 45-year period, you'd have a cool $1 million at the end of it? Seems too good to be true? Well, that is exactly what the power of passive investing is capable of. I know your school and parents taught you that investing is only for those Harvard graduates with fancy degrees. Leave it to the pros, and that it is far too risky. But ladies and gentlemen, investing is actually very simple, doesn't require much money to start, and it's only as risky as you make it out to be. So with all of that said, I think it's time I explain what these index funds actually are. I like to think of them as a shopping basket that includes a little bit of everything. Just how a shopping basket contains vegetables, dairy products, meat, and fruits. All you have to do is swap these items out for individual companies. Let's take the S&P 500 for example. This is a list of the 500 best performing public companies in the USA, which includes the giants that are Apple, Amazon, Microsoft, and so many more. They allow you to invest in every single company on the list with just a click of a button.
Jack Bogle has probably done more for the American investor than any man in the country. And Jack, there he is.
That man right there is John Bogle, the father of index funds, who founded the Vanguard Group in 1974. In 1975, he introduced the first index fund for individual investors called the Vanguard 500 Index Fund, which aimed to track the performance of the S&P 500. He thought instead of trying to compete with the boys on Wall Street who run actively managed funds, basically meaning they like to pick specific stocks at specific entry timings to try and beat the market. Bogle believed these index funds could outperform most of these actively managed funds due to their low fees in comparison. And what a surprise, he was right. Even to this day, the research shows over 89% of these actively managed funds have underperformed the S&P 500 over the last 15 years.
Jack Bogle, many years ago, he wasn't the only one that was talking about an index fund. It wouldn't have happened without him. The truth is it was not in the interest of the investment industry of Wall Street. It was not in their interest actually to have the development of an index fund. Index funds overall have delivered for shareholders a result that has been better than Wall Street professionals as a whole, and part of the reason for that is that they brought down the costs very significantly. I estimate that Jack, at a minimum, has left in the pockets of investors without hurting them overall in terms of performance at all. He's put tens and tens and tens of billions into their pockets, and those numbers are going to be hundreds and hundreds of billions over time.
Bogle's goal was to give shareholders a product that could give a return on their investments that was close enough to the actual market average due to its incredibly low fees. And if we have a look at the average rate of return on the S&P 500 since 1957, it has returned a rate of 11.88% per year. But if we compare that to Warren's strategy on specific stock selection, which made him a yearly average of over 20%, it doesn't seem quite as good. This leads to why does Warren Buffett believe most people should invest passively into these index funds over individual stock selection?
Some people should not own stocks at all because they just get too upset with price fluctuations. Some people are not actually emotionally or psychologically fit to own stocks, but I think there more of them would be if you get educated on what you're really buying, which is part of a business.
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd, because this is not a business where you take polls. It's a business where you think.
Warren believes the most important thing you need is a rational temperament, to not lose your mind when there's a slight drop and to not follow the crowd with sheep-like mentality. The only way to really do this as an investor is to really understand the fundamentals of a company, such as a solid balance sheet and steady cash flow. Buffett also emphasizes the importance of understanding a company's competitive advantage. Sounds like a lot of time and effort, am I right? Exactly. For most people, we can't spend all of our time looking into all of the companies we have on our watch list. We have to work 5 days a week, gotta look after the kids, and we don't want to spend our weekends researching. We would rather put our feet up in a stress-free environment after a long week. Don't get me wrong, being successful with individual stock selection is possible, but it does take a lot of time, dedication, and a stay calm attitude. And this just isn't plausible for most of us. This is where index funds come into play, as passive investing is a lot easier to commit to and properly execute.
The very nature of index funds is that you are saying, I think America's business is going to do well over, or reasonably well over a long period of time, but I don't know enough to pick the winners and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
Warren talks about people being unable to pick which stocks to win on, as well as being unable to pick the right times to get in. Index funds combat the need to pick these winners, as even if a few of the companies do terribly, they averaged out the losses with the balancing of the companies that are doing extremely well. Investors are also able to combat the problem with these winning times to get in with a little something called dollar cost averaging. This is when you invest the same amount of money into the market at the same time intervals. For example, one strategy could be to invest $500 every month into an index that tracks the S&P 500. Another could be to invest $1,000 every 3 months into something like the FTSE 100. This is an index fund that tracks the top 100 companies in the UK. But don't worry about this for now. There are many different index funds that may spark your interest, but you just can't go wrong with the S&P. It doesn't matter when or how much you invest. The important thing is to stay consistent. Having a consistent investment schedule is the only real challenge about passive investing. The only way for this strategy to really work is to look at a 20, even 30-year time period, but the real secret ingredient of this millionaire formula is time. And the younger you are, the more of it you have. So when it comes to dollar cost averaging, the earlier the better.
We started building this little snowball on top of a very long hill. So we started at a very early age in rolling the snowball down. And the trick is to have a very long hill, which means either starting very young or living to be very old.
As I don't want you to start investing today and get excited for your 10% return next year, it's important you must know that even though the S&P 500 historically does have a 10% average rate of return, that is just an average, meaning you won't be getting that every year, unfortunately. Last year, you'd get a lovely minus 20%. The year before that, you would receive a return of 27%. It all depends on very many different aspects, including company earnings per share, revenue, major news involving the companies listed on the exchange, economic data, major political events, and interest rates. So for this strategy to really give you the best chances of a stable return, you do have to be in it for the long run. And just to give you extra confidence, no one ever who has invested in the S&P 500 over a 20-year period or longer has lost money. So without a doubt, you can say these passive investors who have been able to stick to these long-term commitments have reaped the rewards. Now, with all that said, there are always some types of risk within any type of investment. So make sure to do a little bit of extra digging, especially if those individual stock picks have sparked your interest. I just hope you've learned something today about passive investing and why Warren Buffett believes it is the best way to go for most of you inspiring investors out there. Hopefully, instead of looking at investing as this big scary monster we imagine in our heads, I hope you see it in a new light. If you guys have enjoyed, it would be great if you could leave a like, and if you fancy hanging around for other investment tips, make sure to subscribe. Thanks for watching.